Welcome to Cortburg Speaks Retirement, an audio podcast about investing in the stock market, financial planning, money management, and retirement planning. Each Wednesday, we help investors at all stages of life learn how to potentially grow and preserve their money from first job through retirement. Now here's your host, Miguel Gonzalez.
Good morning and welcome to the Cortburg Speaks Retirement audio podcast. On this week's audio podcast, I help investors figure out a 401k strategy that works by matching your tolerance for risk with your investment objectives. Everyone wants a comfortable retirement, but the road to take you there will depend on your specific situation. When you invest, you assume a certain level of risk, but like everyone, you're hoping that your holdings will increase in value. One of the most challenging aspects of investing involves matching your tolerance for risk with your investment objectives. So think of one, beyond your 401k. Have you taken the time to really project the amount of money you may need in retirement? While setting aside a percentage of your income in a 401k is an important step, chances are you will need more than your current limitations may allow you to save. Most people supplement their employer-sponsored retirement benefits and Social Security income with personal investments. In order to develop a fitting plan, you need to have your goals in sight. In 2022, last year, your elective deferral contribution limit for your 401k is $20,500. If you're age 50 or older, you may save an additional $6,500. While the contribution often rises in upcoming years and your employer may match contributions above this limit, will your employer-sponsored plan allow you to save enough? Cast your net as far as possible. Can you contribute to your 401k and still afford to invest in other opportunities? Increasing your savings rate now may help you later. Second thing to keep in mind is your asset allocation and diversification. Are you an aggressive, moderate, or conservative investor? Your answer probably depends in large part on your stage in life and your financial resources and will most likely change over time. Aggressive investors tend to have a longer time frame, as many as 35 years or more to save and invest until they reach retirement, and a greater capacity to withstand loss. For example, the following percentage will vary greatly by investor and their definition of the terms aggressive and conservative investments, but stocks may account for 85% of a relatively aggressive portfolio compared to 40% for a more conservative portfolio. As investors near retirement, their asset allocation strategies generally change to account for lower risk tolerance and an emphasis on income over growth. With a 401k, you become responsible for managing your portfolios, not your employer. While one aspect of the retirement savings plan is investing for the long term, it is still important to stay involved and make adjustments as needed. Choosing to be an active money manager rather than a passive investor can help you maintain the appropriate asset allocation strategy and pursue your long-term goals. Remember that it may be important to diversify within asset categories. For example, spread your equity investments among large cap, mid cap, and small cap stocks, as well as vary your fixed income investments with different types of bonds and cash holdings. The diversification strategy you choose for your 401k should complement your strategies for investments outside of your retirement plan. And number 3 and last thing to consider is your tax considerations. Because retirement plans offer tax benefits, they carry certain restrictions, such as when withdrawals can be made without penalty. While funds in a 401k are made with pre-tax dollars and have the potential for tax-deferred growth, withdrawals made before age 59 and a half may be subject to a 10% federal income tax penalty, in addition to ordinary income tax that will be due. Some 401k plans are featuring the Roth 401k too. If your employer offers this option, you may be able to designate all or part of your elective salary deferrals to a Roth account. Although contributions are made with after-tax dollars, earnings and distributions are tax-free provided you have held the account for 5 years and are at least 59 and a half years old when you access the funds. If you're looking to save specifically for retirement, in addition to your 401k, consider a Roth IRA, which allows earnings to grow tax-free. While contributions are made with after-tax dollars, your withdrawals will be tax-free provided you are older than age 59 and a half and have owned the account for 5 years. Early withdrawals may be subject to a 10% federal income tax penalty unless you qualify for an exemption. Certain income limits apply as well. Taking advantage of tax-deferred tax benefits retirement arrangements offer is a valuable strategy, but also consider building more liquidity and flexibility into your overall savings and investment plan. In the event you need access to funds before retirement, have a contingency plan, so an emergency cash reserve and relatively liquid investments. However, keep in mind how accessing savings in the short term will affect your long-term goals. As you look toward retirement, consider increasing your overall savings rate, maintaining appropriate asset allocation and diversification strategies, and planning for taxes. Over time, your investments will inevitably be affected by legislative reform and market swings, but with a long-term outlook and continued involvement, you are better positioned to manage the fluctuations and changes to work towards your objectives. Investment returns and principal values will change due to market conditions, and as a result, when shares are redeemed, they may be worth more or less than their original cost. Past performance is no guarantee of future results. For more information, make sure to visit our website, www.cortburgretirement.com. Our site is filled with educational videos, ebooks, publications, and financial calculators designed to help you learn more about your finances. As you search our site, send us a note regarding any questions you may have about any particular investment concepts or products, and we will get back to you quickly with a thoughtful answer. This is Miguel Gonzalez, Certified Retirement Counselor and Managing Partner with Cortburg Retirement Advisors, signing off for this week's educational podcast.
The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group LLC, a registered investment advisor. Private Advisor Group LLC and Cortburg Retirement Advisors Inc. are separate entities from LPL Financial. Investing involves risk, including possible loss of principal.